Welcome to Crypto Journal. If you find value in this analysis, hit that like button and drop a comment letting me know if you want more content exposing institutional accumulation patterns before they become public knowledge. In October 2025, XDC Network acquired Contour, a digital trade finance platform that was originally backed by HSBC, Citibank, Standard Chartered, BNP Paribas, and DBS Bank. These Tier 1 global banks had invested in Contour because it digitized letters of credit, reducing processing times from days to hours. Contour had processed over $4 billion in digital trade documents with over 50 institutional pilots before struggling financially and shutting down. Then XDC bought it, revived it, and integrated blockchain settlement. Now here's what almost nobody is discussing. Those same banks, HSBC, Citi, Standard Chartered, already validated that Contour's technology works. They already integrated it into their systems during the pilots. And now XDC owns the platform those banks spent years testing. Meanwhile, XDC's circulating supply of 17.7 billion tokens means that if major banks need to stake XDC for masternodes to process trade finance on the network, or if they need XDC for gas to settle trillions in tokenized assets, the available liquid supply becomes constrained very quickly. Stick around because at the 23-minute mark, I'm going to reveal exactly why the 2030 timeline matters, why banks accumulate infrastructure tokens years before deployment becomes public, and why XDC's current market cap of approximately $1 billion is laughably low if institutional trade finance adoption materializes. Let me start by explaining what institutional accumulation actually looks like, because it's not what retail investors imagine. Banks don't announce accumulation. They don't send press releases stating, "We're buying XDC tokens for strategic positioning." Institutional accumulation happens through multiple covert channels. First, over-the-counter desks. Banks acquire tokens through institutional OTC brokers who facilitate large block trades that don't impact public exchange prices. These transactions don't show up on CoinMarketCap or trading charts. They happen privately with negotiated prices and settlement terms. Second, validated node operations. To run a master node on XDC Network requires staking 10 million XDC tokens. That's approximately $490,000 at current prices. If HSBC, Citi, Standard Chartered, BNP Paribas, and DBS each decide to run multiple master nodes for redundancy and network participation, they collectively lock tens of millions of XDC permanently. That supply never hits exchanges. It sits staked, generating rewards and enabling the bank to process transactions on the network. Third, treasury operations and pilot programs. When banks test blockchain infrastructure, they acquire tokens for operational testing. A bank running a 6-month pilot to digitize letters of credit on XDC needs XDC for transaction fees. They buy tokens, hold them in corporate treasury, and use them for testing. These holdings don't get disclosed publicly unless regulatory requirements demand it. And banks strategically time these purchases during market downturns when prices are suppressed, accumulating before retail awareness increases. Fourth, investment through subsidiaries and venture arms. Many banks have venture capital divisions or blockchain-focused subsidiaries. They invest in protocols strategically without the parent bank name appearing prominently. GSV Ventures, JP Morgan's Blockchain Center of Excellence, Citi Ventures, SDN Ventures from Standard Chartered. These entities make strategic investments and token acquisitions that align with parent bank interests, but maintain separation for regulatory and strategic reasons. And fifth, indirect exposure through ETPs and fund holdings. In October 2025, 21 shares launched the XDC Network EP on the SGX Swiss exchange, with $47 million in assets under management. Banks can gain XDC exposure by purchasing this regulated EP through traditional securities accounts without directly holding crypto. Deutsche Börse Clearstream provides custody. This is how conservative institutions position in crypto infrastructure before direct holding becomes standard. If you're still with me, comment institutional OTC accumulation. I want to see who understands that major banks don't buy on Binance. They accumulate silently through institutional channels. Now let me show you the specific evidence that suggests banks are positioning in XDC infrastructure. Evidence 1, the Contour customer list. Contour's original banking consortium included HSBC Singapore, Standard Chartered Hong Kong, Citi, BNP Paribas, DBS Bank, Bangkok Bank, MUFG Bank, and Tata Steel. These weren't casual observers. They were active participants who integrated Contour into their trade finance operations. Contour processed $4 billion in digital letters of credit through these institutions before financial struggles led to shutdown. XDC's acquisition means those same banks now have a blockchain-powered version of infrastructure they already tested and validated. The integration pathways still exist. The APIs and workflows they built for Contour can be upgraded to work with XDC blockchain settlement. This dramatically reduces friction for readoption. Banks don't need to evaluate XDC from scratch. They're evaluating whether to reactivate infrastructure they already know works, now with blockchain efficiency. Evidence 2, the timing of institutional infrastructure integrations in 2025. In May, XDC integrated with Elliptic, providing AML and compliance tools trusted by over 500 financial institutions. In May, XDC integrated with Utila for institutional custody, enabling banks to hold XDC assets in MPC wallets with $8 billion monthly transaction processing capability. In June, XDC partnered with CRYMBO for embedded compliance at protocol level. In July, XDC integrated Layer 0 for omni-chain interoperability, connecting to Ethereum, Solana, Arbitrum, and BNB Chain. In September, XDC integrated native USDC via Circle's cross-chain transfer protocol version 2, enabling seamless stablecoin settlement. Every single integration in 2025 was infrastructure that banks require before deploying blockchain solutions. Compliance monitoring, institutional custody, regulatory reporting, interoperability with other chains where bank assets exist, stablecoin settlement rails. XDC didn't build features for retail speculators. They built institutional-grade infrastructure. And institutions don't demand this infrastructure unless they're planning to use it. Evidence 3, the validator network composition. XDC Network currently has over 108 active validator masternodes with over 300 candidates. Each masternode requires 10 million XDC staked. That's 1.08 billion XDC locked just in active masternodes. From a 17.7 billion circulating supply, that's 6% permanently locked. But here's the critical detail. Deutsche Telekom, one of Europe's largest telecommunications companies, operates an XDC masternode. This isn't a crypto startup. This is a $72 billion market cap corporation running blockchain infrastructure. If Deutsche Telekom concluded XDC merits running a masternode, what analysis did they conduct? They evaluated enterprise blockchain demand, institutional adoption trajectories, and strategic positioning. Their presence validates XDC as enterprise-grade infrastructure. Evidence 4, the institutional RWA tokenization momentum. In February 2025, Arcax launched tokenized money market funds from BlackRock, Fidelity, State Street, and a burden on XDC Network. These aren't test tokens. These are real institutional assets under management now settled on XDC infrastructure. In July 2025, Vert Capital announced a $1 billion real-world asset tokenization initiative on XDC, focusing on agribusiness and corporate debt. $1 billion in tokenized assets flowing through XDC creates sustained transaction demand and gas fee usage. And in October 2025, 21 shares XDC-EP launched with 47 million in AUM. This European regulated product provides institutional investors direct XDC exposure. These aren't coincidental isolated events. This is systematic institutional infrastructure building. BlackRock, Fidelity, State Street don't tokenize assets on random blockchains. They evaluate compliance, scalability, custody solutions, and long-term viability. Their presence on XDC signals institutional confidence. Evidence 5, the regulatory sandbox participation. XDC Network launched Stablecoin Lab to pilot regulated stablecoin issuance and settlement with banks and regulators in US, EU, and Asia. They joined the MiCA Crypto Alliance in June 2025, working with European regulators to establish compliant frameworks. They partnered with Singapore's IMDA for Trade Trust digital trade infrastructure. This isn't speculation about future regulation. This is active engagement with central banks and regulators building frameworks for institutional blockchain adoption. Banks participating in these regulatory sandboxes are testing infrastructure before public deployment. They're accumulating technical knowledge, operational experience, and yes, the tokens needed to run that infrastructure. Comment BlackRock validates enterprise grade if you're recognizing that institutional asset managers don't deploy on unproven infrastructure. Let me explain why the 2030 timeline is critical for understanding institutional accumulation. Banks operate on 5 to 10-year infrastructure deployment cycles. When they decide to migrate systems, the process involves research, pilot testing, vendor selection, integration, compliance validation, and scaled rollout. This takes years. If banks concluded in 2022 through 2024 that blockchain trade finance is strategically necessary, they're in pilot phases now in 2025. Scaled deployment happens 2027 through 2030. Public announcements of success happen after deployment is proven, likely 2031 through 2033. This timeline explains why accumulation happens now in 2025. Banks position 3 to 5 years before public deployment. They acquire tokens when prices are low and retail attention is minimal. By the time deployment is announced and mainstream media covers institutional blockchain adoption, early accumulation is complete. Prices have already appreciated significantly, reflecting fundamental demand. 2030 specifically matters because of converging macro trends. First, ISO 20022 migration is complete. SWIFT's legacy MT message format was fully retired November 22, 2025. Every bank globally now operates on the new standard designed for blockchain integration. XDC's ISO 20022 compliance positions it for institutional adoption as banks explore blockchain-compatible messaging. Second, tokenized RWA market projections. Industry analysts project tokenized real-world assets will reach $16 trillion to $30 trillion by 2030 to 2034. If even 1% of that tokenization happens on XDC infrastructure, that's 160 billion to 300 billion in assets settling on XDC network. The gas fees, transaction volumes, and token demand from that activity is enormous. Third, trade finance digitization reaching critical mass. The ICC and WTO project that 2030 is when digital trade documents and blockchain-based letters of credit become standard rather than experimental. MLE-TRL frameworks, electronic trade document laws in UK, Singapore, and other jurisdictions, all targeted 2030 as the maturity timeline. XDC built infrastructure specifically for this timeline through Contour acquisition and trade trust partnerships. And fourth, generational wealth transfer. By 2030, millennials and Gen Z will control significant portions of global wealth. These demographics are crypto native. They prefer digital assets over traditional banking products. Banks serving these clients need blockchain infrastructure. XDC positions as the institutional-grade solution that bridges traditional finance and digital asset expectations. Banks aren't accumulating XDC for 2026 gains. They're positioning for 2030 deployment when blockchain trade finance becomes industry standard. If you're still watching, comment 2030 infrastructure deployment. I want to know who's thinking in 5-year timelines like institutional strategists. Now let me address the supply dynamics and why bank accumulation creates price pressure even without public announcements. XDC has a maximum supply of 17.76 billion tokens, with approximately 17.74 billion circulating. Circulating supply is essentially at max. No significant unlocks coming. This is critical. Unlike projects with massive vesting schedules that create perpetual selling pressure, XDC supply is fully distributed. But effective liquid supply is much lower. 1.08 billion XDC is locked in masternodes. Over 300 million XDC is staked beyond masternode requirements. Exchange cold wallets hold hundreds of millions for operational liquidity. Lost wallets from early holders who lost keys or forgot about positions probably account for additional supply permanently removed. And now, institutional accumulation through OTC purchases, ETP backing, and treasury holdings removes more supply from liquid circulation. If we conservatively estimate that 3 billion XDC is locked, staked, lost, or institutionally held, that leaves approximately 14 billion in liquid circulating supply. If major banks each accumulate 50 million to 100 million XDC over the next few years for masternode operations and transaction needs, that's another 500 million to 1 billion tokens removed from circulation. The supply squeeze happens slowly then suddenly. Gradual accumulation over years doesn't move price significantly because banks use OTC desks. But when deployment scales and transaction demand increases, those banks aren't selling their strategic holdings. They're using XDC for gas fees, which burns tokens through transaction processing. And new demand from other institutions seeing successful deployment competes for remaining liquid supply. This is classic infrastructure token economics. Early accumulation by strategic holders, shrinking liquid float, increasing fundamental demand from usage. Price discovery when float scarcity meets scaling demand. This is Crypto Journal, and I want to leave you with this. The institutional accumulation thesis for XDC isn't based on leaked documents or insider information. It's based on observable evidence. HSBC, Citi, Standard Chartered, BNP Paribas, and DBS Bank invested in and tested Contour for years. XDC now owns Contour, an integrated blockchain settlement. Those banks' integration pathways and validated use cases still exist. XDC built comprehensive institutional infrastructure in 2025. Elliptic compliance, Utila custody, MICA alliance participation, native USDC, layer 0 interoperability. Every piece banks require. BlackRock, Fidelity, and State Street tokenized assets on XDC. Vert Capital committed $1 billion to XDC RWA tokenization. 21 Shares launched a regulated ETP. Deutsche Telekom runs a masternode. These aren't speculative crypto projects. These are institutions with trillion-dollar operations validating XDC as enterprise infrastructure. And the 2030 timeline for ISO 20022 maturity, RWA tokenization scaling, and trade finance digitization aligns perfectly with 5-year institutional deployment cycles. If banks concluded in 2022 to 2024 that blockchain trade finance is strategically necessary, they're accumulating now in 2025 during market consolidation when retail attention is low. Deployment scales 2027 through 2030. Public announcements happen 2030 through 2032 after success is proven. By then, accumulation is complete and price has moved. For XDC token holders, the thesis is understanding institutional behavior. Banks don't speculate. They position strategically years in advance. They accumulate infrastructure tokens the way they accumulated cloud computing exposure before AWS became obvious. The way they positioned in mobile payments before fintech explosion. The way they bought real estate in emerging markets before development arrived. XDC at a $1 billion market cap with institutional infrastructure, banking validation through Contour, regulatory compliance, and converging macro trends for 2030 represents asymmetric opportunity for those who think like institutions rather than retail traders. If you found value in this institutional accumulation analysis, hit that like button and drop a comment telling me, do you think major banks are secretly positioning an XDC for 2030 trade finance deployment? Or is this thesis too speculative? Your perspectives help shape how I approach future content. Why major banks may be secretly accumulating XDC for 2030. Not through press releases. Through OTC desks, masternode staking, subsidiary investments, and ETP exposure. The accumulation happens in silence. The deployment happens in 2030. And retail discovers it in 2032 when it's already priced in. See you in the next one.